It is the quintessential show here on YouTube, and this time we are talking personal finance because we thought, we need to talk about finance. We need to get millennials thinking about finance, and around people who are around the age of 24 upwards, who are graduating from university and making it into the workforce. What is available for them to take the salary that they're getting and grow it exponentially? And when you start listening to podcasts about investment and you start trying to find, well, you go out and find that content. One of the names on Twitter, at least, is Stealthy Wealth. And I know the guys from Just One Lap have also spoken to Stealthy Wealth. And I thought, we need to get this guy on the Quintessential Show because it sounds like he knows what he's talking about. What is up, Stealthy Wealth?
Hey man, it's good to be talking to you, man.
Yeah, Stealthy, you're so stealthy we can't even see your face. What's going on here, man?
Yeah, I know. Just with the full financial disclosure on my blog, just to protect my family, I've decided that I won't be revealing my identity just yet. So yeah, I'm staying anonymous for now.
I like it though. It's like it's kind of like a Robin Hood type of thing. You're gonna give us some stuff and disappear, and we'll be happy. We'll be happy with all the advice that you give us. But Stealthy runs a personal finance blog, and on it he says you will find his thoughts on investing, cutting costs, financial discipline. How long have you been running this for, Stealthy?
It's probably about 2.5 years now, more or less. Started sort of mid 2016.
Right, and it sounds quite ambitious because when you go onto the site itself, you say that this whole thing, this whole experiment, Stealthy Wealth, is all about wanting to retire at the age of 45. I mean, come on, Stealthy, are you confident that you could retire at the age of 45 in modern day South Africa?
Yeah, well, that's the plan. Obviously, I'm expecting hiccups along the way, but a plan is a great starting point. And if I can get in, my initial target was 15 years. If I can do it in 15 years, that'll be great. If I can do it in less, that'll be even better. But even if it takes 20 years, I'll be perfectly happy with that outcome. It's still better than the 9 to 5 for 40 years until you're sort of 65 years old, and then praying that you have enough to see you through to retirement.
Yeah, I think the government makes us look towards our retirement age and says, kind of around 65, that kind of age group is when you're going to retire. But I mean, putting it at 45 is quite audacious.
Yeah, well, I mean, society dictates almost. You leave varsity, you enter the workforce, and we're just told to accept that this is how it is. You're going to be working for 40 years, and when you're 65, you're going to have some sort of pension. You have no idea what it's going to be, but you just better hope that it's going to be enough. And I thought to myself, sure, that's one way of doing it, but why must we just accept that that is the way it's got to be? Is there a better way? And did some reading around the topic, and found some really cool overseas blogs and some local stuff as well. And I realized it's actually perfectly possible with a little bit of discipline and perseverance and patience to retire a lot sooner and control your time.
Yeah, but that's one of the things about your tweets as well. You tweet out quite bravely and saying these are the kinds of things that financial advisors are not going to tell you. Is there a kind of, I don't know, anti-financial advisor thing that's coming up in South Africa where the financial advisors for too long have given people products that just don't work, and now you can take it into your own hands and actually thrive?
To a certain extent, yes, but I think it's not just the advisors. I think it's almost the whole industry that's almost built on people not knowing where their money is going and what it's doing, and this whole lack of knowledge means that they can charge sort of these audacious fees because no one's really going to question them because they don't know any better. Um, but I mean, in this day and age, ignorance is no longer an excuse. You can find out everything you need to know on the internet if you're just willing to put in a little bit of time and effort.
Yeah.
And in the case of investing for your retirement, that little bit of time and effort ends up paying you in the millions even of rands if you can save yourself on the fees and going through a financial advisor.
Yeah, I think a lot of South Africans out there have been told by family members that never had so much information at their fingertips that investing is like gambling. And I worry about that because it's scared a whole generation of people from investing. So I mean, what do you say in response to people like that?
Yeah, personally, I've been very lucky in the sense that my dad sort of did instill some excellent lessons from, even when I was in standard eight. I remember discussing, sort of, trusts and that with him.
Hmm.
So I've been very fortunate in that regard. Um, Other people, well, coming from my point of view, because my dad taught me that that was the way I went initially, and I started investing from a young age. So I can imagine if my dad had said, "Oh, you shouldn't invest; it's risky. You should rather put your money in the bank, or
Hmm.
debt is not that bad." I would have very well believed him for many years before I figured out, maybe this is not actually such a good idea.
Yeah.
Um, so I think people do take what they learn at home. And again, it's because who can you trust in the financial industry? You're always worried that you're going to somehow someone's going to screw you over.
Mm.
So you trust sort of family members, and if they're giving you bad advice, you're gonna implement that advice for many years before you possibly figure out, if at all, that maybe this is not such a good idea.
Yeah, I mean, investment is a scary thing. To get somebody to click on that, buy shares button is a very scary thing to some people. It might make them break out in cold sweats. But I do think it is becoming easier, through services that do now allow you to buy fractional shares and those kind of things. Because back in the past, you'd be like, oh, I'm buying one company for 200 Rand a share. I think that would have been a little bit of a scary situation when you don't know if that company is going to do well. So
Yeah,
it has become easier, surely.
absolutely. And I think, you talk about fractional shares, and Easy Equity is the company that's doing that. And I think what's really great about their account is, before you even FICA, they're willing to give you a demo account with 100,000 Rand, monopoly money that you can play with. And I think that's a great way for people to use the platform and see how the buying and selling works, because that's, normally considered black magic, how this buying on the stock exchange works. So I think that's a really great initiative of them, that you can, without any obligation, go onto their platform, see how it works. You can go buy a Satrix 40 ETF, see how that buying works, what the costs are, and so you're fully prepared by the time you're willing to actually put some real money down.
Yeah. Now, Stealthy, through your studies of investment, if you can call them studies at all, you've figured out some sort of mantra that you've told yourself. Apparently, it's your secret for generating wealth. To become wealthy, not exactly rich, but wealthy, is spend less than what you earn, invest the difference, and wait. I think that's something that South Africans need to hear, because I don't think they get that kind of financial advice from anybody. Spend less than what you earn and invest the difference and wait. So, in your opinion, the short term investment is kind of out the window. You're kind of focusing on the long term investment.
Absolutely. And it sounds so simple and in theory, and it really is simple in theory, but it reminds me of losing weight. Everyone knows how to do it. You just need to eat healthy and you need to exercise. But how many people are actually doing it? That's where the problem comes in, is the implementation. So instead of people doing the long, slow, boring way of month in, month out, just spending a little bit less than what you earn and taking that difference and investing it, they struggle to do that. And the answer to generating wealth is right there. It's exactly in that. There's no other way to do it reliably except to spend less than you earn, and just invest the difference and then wait. And by wait, I mean, this is not a 3-year get rich scheme. This is, 10, 15, 20-year plan. And if you're willing to stick it out, you'll be well rewarded at the end.
Yeah, and that's the thing. You got to start as early as possible, doing this. I think that's what some of the lessons that we learn too late is, start when you can. But that's the thing. You're in high school, you're not really one of those guys that is thinking about it. Even in university, you're not thinking about investment as much as somebody who's probably studying accounting or something like that is. So you have a whole bunch of, potentially humanities students who aren't thinking about investment at all. But they need to learn to live within their means. Would you say that's something that's true?
Yeah, I think what happens with a lot of people is they see their salary coming in. Okay, say it's 20,000 Rand, and they say, right, it's 20,000 Rand. I've got 20,000 Rand to spend. How can I spend it? And that's maybe the totally wrong way of thinking. They should be saying, okay, I need to have accommodation. I need to have a car. I need to have groceries. What is a reasonable amount to spend on that? And then instead of buying and filling up your paycheck, buy what you need, and then invest the difference. But even to flip that on its head, what you should rather be doing is saying, okay, I've got 20,000 Rand coming in. I want to invest 2 or 3,000 Rand of that, and do that first at the start of the month. Because the thing about people is, you are highly adaptable. If you're earning 20,000, but you're putting that 3,000 away, say, and then you end up with 17,000, you'll live on that 17,000. You'll find a way to make it work, because you are highly adaptable. The first couple of months, maybe you miss that 3,000 Rand, but after a while, you'll even stop thinking about it, because it's just automatically going off every month, month in, month out, that you don't have that money, you'll forget about it, and you'll carry on with your life on your 17,000 rand.
Yeah.
And I think maybe that's maybe a good starting point for someone who's entering the workforce, because the sooner you can get into a habit of spending less than you earn, as you move through the career ladder and you start earning more, you'll be able to start saving more and more and more, because that habit would have already been instilled in you.
Yeah, but I mean, we're always bombarded with all these things like depreciating investments. It's like get the new cell phone or get the new car, and you do this before you even potentially have a house, or if you even have investments in the first place. But this is my point. Millennials don't know where to invest their money, and I mean, in your opinion, through the blog, what are you telling people to invest in?
Yeah, so um, I'm a big fan of, or maybe I should start at the beginning. So you get a couple of asset classes. You'll know about some of them: property. That can be a house or listed property on the stock exchange. Cash. Everyone knows what cash is. The thing in your bank account. And then you get equities. And equities is just basically companies. That do business. There can be various companies, banks. ShopRite, Checkers. Pharmaceutical companies, etc., etc. And history has shown that time and time again, equities give you the best returns if you are willing to give them enough time. So for a long-term investment, you want to be in equities, because that's your best shot at generating the best returns. And now there's a few ways you can invest in equities. You can either buy the companies directly. So you can go out and say, okay, I think ShopRite's going to do well, so I'm going to buy some of those shares, and I think Standard Bank's going to do well, so I'll buy some of those shares. But you could very well think that Steinhoff was going to do well, and you end up buying some of those shares, and we all know how that worked out.
Right.
So it's risky to buy single companies, as Steinhoff has proven. So what you basically want to do is you want to buy a large number of different companies across different sectors that operate even in different countries, so that you spread your risk. So if you only have 2% in Steinhoff and it goes to zero, you've only lost 2% of your investment. That's, you can recover from that. So there's a couple of ways that you can buy these multiple companies in one product. The first is unit trusts. And I started investing in unit trusts because that's pretty much all there was back in the day.
Right.
And there's nothing wrong with that, except that they're a bit pricey. Fees are kind of high. And again, you're trusting someone to be able to pick the right companies. And there were many unit trusts that chose Steinhoff, and there were many unit trusts that invested in African Bank. So they can go wrong, they can underperform. And in fact, most of the fees, most of them do underperform. In fact, I think it's something like, depending on the benchmark you look at, but 90% of investment professionals running unit trusts actually don't beat the benchmark.
Good grief.
So you can do it, and you might be lucky, you might pick one of the 10% that do. The problem with picking that 10% that beat the benchmark is, over the first 5 years, it might be company A, but then the next 5 years, company A is like in the bottom, and company B is now the best performance. So there's no ways of knowing which ones are going to do well. So I've accepted that, I'm not going to be able to do that. So what if I could just get the returns of equities? And the way you do that is you buy an ETF. Because an ETF is very similar to unit trust in terms of it owns multiple companies across multiple industries and multiple geographies generally. But they don't try to outperform the market. They buy their companies in the exact same ratio as what makes up the entire index.
Yeah.
So that by buying that, you are getting exactly the index, nothing more and nothing less. So there's no chance of you underperforming. There's also no chance of you overperforming, but that's okay, because generally the markets go higher and you'll get exactly the market return. So they say exactly what they do on the sticker.
Yeah.
So I'm a fan of ETFs. They are low cost. They do what they say, and you can get incredible diversification with just one product, which is great.
Yeah, and there's a handful of companies in South Africa that will actually sell you these kinds of exchange traded funds. Well, at least you can go through a broker, or how many brokers in South Africa deal in exchange traded funds?
Yeah, I think generally any broker, you'll be able to buy them. There are some of the ETF providers themselves offer you a platform online, but if you use that, you're limited to only buying the ETFs that provider offers. So if company A has 3 ETFs and you invest on company A's platform, you can only buy those 3 ETFs, which may or may not be the cheapest or the best suited for what you want to achieve. So for that reason, I prefer buying them through a broker, and my preferred broker is Easy Equities, purely because they have zero annual fee, zero platform fee, zero maintenance fee, zero account fee, all those usual fees that a lot of the brokers charge. Easy Equities doesn't have them. And then they also have the cheapest brokerage in the country. And for those that don't know, brokerage is just the cost you pay every time you buy or sell a ETF or a share. So you want that to be as cheap as possible, because it means more of your money is actually going towards you and less of it is going to buying someone else a Ferrari.
Right, yeah. So the thing is, I mean, exchange traded funds, for the people listening, that's what ETFs are. They are now part of the sensible investor kind of, that's what we're handing down to people and saying, listen, maybe look at exchange traded funds. But the South African government has made it even sweeter with the tax-free savings accounts that we can max out every year. Now, tell me, tax-free savings accounts, that's also what you've kind of instructed people to say for retirement specifically. Tax-free savings accounts with exchange traded funds inside of them. Is that something that you're telling people in terms of retirement you should be looking at?
Yeah, so I'm a huge fan of tax-free savings accounts, but I think I must give a little bit of context as well. Bear in mind that I'm not on what most people would call a normal retirement plan.
Right.
Um, so tax-free savings accounts are great for me because you put your money in. You're allowed 33,000 per year. So if you're going to do that monthly, it's 2,750 rand a month per person. So if you're married, you and your spouse can do that. So then it's 5,500, which is what myself and my wife are doing. And then once the money is in there, it is totally, all the growth and everything going forward is totally tax-free. Even once you're selling units, even if you're living off the dividends, no matter what's going on inside that account remains 100% tax-free, which is, that's like a real bonus. So that's like the tax-free savings account is like a wrapper, but you still need to put, or a bucket, should I say, but you still need to put some stuff into that bucket. And the stuff I like to put in the bucket is the ETFs that we discussed previously. So that combo there is power. It really is power.
Yeah, and I mean, these things pay out dividends as well, and all those dividends get reinvested into whatever you are holding. And that is also essentially tax-free, or is there some sort of dividends tax there, or is it all tax-free?
So generally, if you're in a normal account, you'll pay 20% on dividends. In the tax-free savings account, you pay zero. I must just say, some of the ETFs that have international holdings, companies in America, and that, trust me, the American government doesn't care that little old you and me are in a tax-free savings account here in the southern tip of Africa. So they do pay some dividend tax there. I think some of it is automatically reclaimed by the ETF provider, but there will be a small tax drag on the dividends only of the international ETFs. The local ETFs are 100% of the dividend that arrives in that account remains yours, and nothing goes to tax.
Yeah. So, I mean, we're telling people who historically have been told by their companies, oh, here's your retirement annuity, we're going to add to it every single month. We're telling them to kind of undercut that process. And we're telling them, listen, the grass is greener on the other sides of TFSAs and ETFs. Is that true?
Yeah, so what happens with a lot of people that are employed, especially at some of the bigger companies, is you are forced into the company's pension fund, which may be structured as an RA, or it might be structured as a pension fund. They're more or less the same thing. There are rules around it in terms of you have to have, you can't have more than 75% in equities, you can't have more than 30% international, and I think 10% into Africa, something like that. So there's rules around that. And unfortunately, if you're working for a company that offers one of those, you don't have much say. So the company I work at has a pension fund. So I really have what, like, they lump the RAs, the pension funds and the provident funds, they call them Regulation 28 compliant funds, because Regulation 28 is what governs the rules around what you can and can't invest in.
Yeah.
So you already got some, automatically got some Regulation 28. So you're already subjected to those rules. So now if you go and open an RA as well, then you're lumping sort of all your investments into this Regulation 28 fund, and you are limited in terms of what you can invest locally, what you can invest overseas, as well as what asset classes you can put in there. So yeah, you don't have a say in terms of your company's pension fund, but any money over and above that, you should maybe look at TFSA instead, so that by the time you retire, you have a lot more tax flexibility. Because with the Regulation 28 products, the pension funds and RAs, when you retire, you're forced to convert that product into, you can only take a third as cash, and the other 2/3 has to go and buy an annuity product, which will incur income tax. So the benefit of the RA is you get a tax break up front, but you pay tax later on. Whereas with the TFSA, you don't get any tax break up front, but you'll never ever pay tax again on that money, and that's why I like them.
Yeah, I think there will be a rising class of millennials who might have done TFSAs before they had ever gotten some sort of formal employment that gave them an RA. I mean, in my case, that's actually the truth, you know. I mean, a lot of freelancers or guys that aren't getting RAs from their companies are thinking, geez, like I need to find a way for my freelancer money to grow and all of that kind of stuff, or my journalism money to grow. And if you're not part of a company that's, you know, putting little pockets of your money away every month, you're missing out on that essentially. But now tax-free savings accounts allow you to kind of undo the damage of never having a retirement annuity. But you have something against retirement annuities in any case, because you can go get a retirement annuity through an assortment of companies in South Africa. Even through the Easy Equities platform, you can get a retirement annuity now. But do you still have something, you have a grudge against retirement annuities? What is it?
Yeah, so that's
Tell
a
me.
little bit of a blanket statement. I should maybe put it into context because I don't want a mob arriving outside my door with flaming torches and everything.
Right.
Look, retirement annuities, the tax benefit is hard to argue against, but I think you need to just think carefully because the thing with retirement annuities is you cannot touch that money until you're 55. So this is why I want to put into context. Bear in mind that I'm planning to retire at 45, so I need the money 10 years sooner than what a retirement annuity is going to allow me to access it. So if you're on a normal retirement plan, you've got no ambition to stop earlier. You don't mind your money being locked away until 55. And for some people, that's actually an advantage because, some people maybe think they might not have the discipline and they'll be tempted, when that holiday or next World Cup is calling them to go watch, they might be tempted to tap into the RA and cash it out. So for those kind of people and the ones that's, looking at a sort of more normal path to retirement, RA can work really, really well. I think just know what you're getting yourself into in terms of, when you're allowed to access the money, and also just know that there will be tax at the end on both the lump sum you're allowed to take out, as well as possibly the income that you will draw from the annuity that you'll be forced to convert that RA into.
Yeah.
So I think it's just a little bit of knowledge and I've got nothing against them per se, but for early retirement, they're not particularly well suited.
Yeah, well, especially for the kind of retirement you're trying to do. So okay, cool. I get it. I get it in the context of what the blog and what you're aiming for. That retirement annuities are it's not in your kind of wheelhouse at the moment. If you want to,
Yeah.
do it at 45. But TFSAs can't be enough for retirement at 45, can they?
Yes and no. So I did a really interesting calculation. I looked at what would happen if someone aged 21 maxed out their TFSA. So that's the 2,750 a month we were talking about earlier. And they did that for 15 years until they basically hit the lifetime limit of the TFSA, which is 500,000. So that would take them to about age 36, right? And after that, they don't contribute to anything else, and they just go and blow all their money. And then if they had to marry someone who did the same, and they cruise on happily along, and then by age 65, I think it was, or it could have even been 60, they would have 10 million between them. And that is enough for not an extravagant retirement with yachts and, visits to Monte Carlo and all that, but 10 million, you'll have a pretty comfortable retirement. But again, that speaks to starting early and not touching the money, leaving it for what it's intended for.
Yeah.
So a TFSA can be pretty powerful, and it even by itself, a couple would be able to comfortably get a decent retirement.
Yeah, those numbers are scary. It sounds like too good to be true.
Almost, right? Yeah.
Yeah, that's it's kind of the conundrum. But I like what's on your Twitter and all that kind of stuff. You seem to go anti the public opinion. I saw the other day you were telling somebody, oh, by the way, petrol hasn't actually beat inflation. You said something about petrol. Tell me about that, because people were complaining, oh, petrol's so expensive, and you were actually like, well, it's actually not that expensive if we take a look at all the figures and facts. Do people kind of not think about facts when they're complaining about financial things in South Africa?
Yeah, you know what? I think people sort of live for the now, So, and over the last 2-3 months, absolutely, petrol has got expensive, So people are going to be very upset when I start saying, oh, petrol actually hasn't increased by more than inflation. So the cost of petrol has actually gone down relative to inflation over the last 5 years. Can you believe it? I was actually also really surprised. But if you look at the petrol price 5 years ago and you look at the petrol price now, you're actually paying less in real terms now compared to 5 years ago. Impossible to believe, I know, I know. But I read something also really interesting. Apparently, if you look at how South Africans perceive South Africa and the reality of how things are like in South Africa. So they did this sort of for every country. So, they did it in South Africa and many other countries. And South Africa actually ranked last, which means that people in South Africa are just generally negative and they always perceive our country to be far worse than what's actually happening on the ground. But I just, I'm generally an optimist, and I just sort of like to remind people every now and then, you know what, we've come through a lot worse than what we are doing now. Most people do not know what it was like back in the 80s when we had sanctions and politicians that make today's lot look like amateurs. So you just need to remember we came through a lot, and I have a lot of belief and positivity about South Africa, and especially the people that are in South Africa. I really do believe we can get through anything. So, sometimes people just needed to be reminded about the positive side of things instead of, just getting engrossed in the latest doom and gloom headlines, and you read the comments in the articles, and it just can really get you down.
Yeah, but that's the thing, when there's a headline that the market actually reacts to in South Africa, and then you go and see your TFSA and your international holdings look fantastic, then you're kind of like, well, it's not that bad, I'm getting a good deal out of it, as bad as that is to say.
Yes, but again, that it's, as much as I'm positive about South Africa, it doesn't mean I've got all my investments in South Africa, because I wouldn't even put all my investments in America. Right. That's just, it's again speaking to this diversification. You want your investments across multiple countries, multiple currencies, multiple sectors in the economy. So like you say, yes, if the rand suddenly tanks to, geez, what are we back at, like 1470 or something now? The international stuff starts doing well. If the rand strengthens, maybe the international doesn't do so well, but it's sort of good for our economies. So then the local stuff starts picking up again.
Yeah.
So it's about diversification, yeah.
Yeah, when we're recording this, the rand to the dollar is 14 rand 92. So just putting it out. So it's not all doom and gloom, but it's pretty bad. Hey, it's pretty bad.
No, look. We've had better times in this country, but believe me, we've had worse times, and people just need to remember that.
Yeah, but that's the thing. I think a lot of people add that negativity onto the whole thing of just not willing to learn anything financial because all they get fed are those headlines, and then they just decide, you know what, it's too hairy for me. I can't think of finances right now, and then they go make a bad choice and they go buy something impulsively just because they feel negative about the country. But what I like about your website is that it's starting to undo that kind of thinking, and it's starting to make people think, maybe I should live within my means. But here's a question before we get off of RAs. So this
was RAs, eh?
I'm sorry. I'm so sorry because I too want to retire. But it's one of those things. If I was in the position to both max out my TFSA in a year and pay into an RA, is that a good idea? Tell me.
Sure, that's an interesting question. Look, I think it's personally, I think maxing your TFSA should be your first port of call.
Okay.
If you've got more than 2,750 a month, then you can definitely start looking into an RA. And again, I wrote an article on the 9 reasons I don't like RAs, and we've discussed some of them, in terms of locking your money up till you're 55. There's tax payable at the end. But also some of the other reasons is, there's normally fees involved in an RA. Okay, the newer providers are really coming to the party in terms of dropping fees. But if you end up in one of the older products, you're going to be paying a whack of fees. Whereas with the TFSA, it's entirely possible to get a totally free TFSA account. You can do that with Easy Equities, and I think there's even other providers that offer it as well. And then we discussed that, with an RA, government's regulating that you can only have 75% in equities and no more than 30% offshore. So that will also put a bit of especially over the longer term, a bit of a drag on the RA performance. So a TFSA that's 100% in equities and well diversified across the world, with even 100% offshore if you like. RA is limited, and most of them end up with cash and bonds as part of the portfolio mix, and cash only returns inflation if you're lucky. So that puts a bit of a drag on the performance. So the higher fees in the RA and the lower performance means, even with that tax benefit on the RA, the TFSA sort of does kind of keep up.
Right.
And then with the TFSA, you're not paying any tax at the end. Whereas with the RA, you can take a third lump sum, and trust me, SARS is going to want some of that lump sum. I think you only get, I think it's $500,000 tax free. which sounds like a lot of money, but come retirement time, that's not that much. And then after that, you have to convert the other 2/3 into a guaranteed or living annuity, which you can draw a monthly income from. But that monthly income is going to get taxed at income tax, which is, depending how much you take, can be as high as 45%.
Yeah.
TFSA, if you're taking an income from a TFSA, you pay zero tax. So yeah, it's a difficult one. For me personally, I prefer the TFSA before the RA, but I'm not going to argue against anyone who wants to do the RA first, because that upfront tax benefit it can be worth it, especially if you are in the higher tax brackets while you're still working.
Yeah, but I mean, what do you do with all that remainder of the money that you have lying around? Say, for example, you tax out, well, you max out rather, hopefully not tax out anything. Please, we want tax efficiency, please. No, when you max out your TFSA, right, and you still have some leftover money, would you say pump that back into stocks, or would you just say leave it in the bank type of thing?
Well, look, if you still got some money left over, you should be looking at an RA after your TFSA, because of the tax benefits that you do get up front. And then if you can look at what they call a discretionary portfolio, which is, there's no tax benefits. That's just a normal investment. But I doubt that's going to outperform the tax benefit of putting it into an RA. What you do get by going discretionary is you can, it's your choice. You can go and put 100% offshore, and again, it comes down to those limitations of the RA, what you are and aren't allowed to invest in. So if it's important for you to be 100% offshore for whatever reason, then maybe you skip the RA and you do the discretionary investment instead. But the tax benefit from the RA is pretty difficult to argue with.
Yeah, yeah. So, okay, I think I got my answer out of that. There's a potential loophole here where we can get the RAs, the ones you don't like that much, but hey, we'll see.
Just one more point on the RA.
Go ahead.
So, when you invest in the RA, you get the tax benefit, and it's given to you as a rebate when you do your e-filing. So SARS, basically, you pay full tax during the year, and then they look at how much you contribute to your RA, and they refund you according to that. But now, if you're going to go and take that refund and say, that 72 centimeter LCD TV is looking good and calling my name,
right?
Have you really benefited from the tax benefits? I don't think so. So just be careful with that. You're not getting any benefit if you're blowing the rebate. What you should be doing is taking the rebate and reinvesting it. Then you really are scoring on the tax front. So just keep that in mind as well.
Yeah, but okay. To return to tax-free savings accounts, when we started Quintessential ZA, we said, what, we want to build a new nation with the next generation, and we want them to be financially. We just want to introduce them to things that are going to lead to their financial independence. And we, with Candace Payne, had built this quintessential basket, which I thought wasn't a bad start for somebody out there who wanted to, buy just a basket of, let me just buy this thing and let it run, because some people are too scared to go out shopping, so I think that's what we tried to do with the basket. So if you have made it to this point of the interview with Stealthy Wealth, if you don't know yet, we're not really advertising for Easy Equities, but Easy Equities does give a really, really good deal as to finding ETFs at very, very low brokerage fees and all of that kind of stuff and we've kind of put them in a basket as well, so you can buy them. So we started the quintessential basket, and quintessential in its definition is like the atypical highest class of what you could be looking for. So we just wanted to find things that can help your regular day South African. I then sent it through to Stealthy Wealth, and Stealthy Wealth hit me with something that this millennial didn't know what he was talking about. He said there was a lot of smart beta stuff that was sitting in this quintessential basket, but I'll give you guys an idea of what's in it. We have a Satrix MSCI World ETF, then we have a New Funds Equity Momentum ETF, then a Satrix Quality South Africa Portfolio ETF, and they're all in the red, by the way. I don't know why. Something's wrong, but anyway. Satrix MSCI Emerging Markets ETF, and then a Signia iTrix Fourth Industrial Revolution Global Equity ETF. So you told me that there's some smart beta stuff in there, and I'm quite confused as to what you mean. What is smart beta, and why is this a controversy in the investment world at the moment?
Yeah, I felt really bad knocking it, because it's a great initiative that Easy Equity and you did. I mean, to try and encourage people to invest and make it exciting and make it easy for them by buying one product. They're getting huge diversification. But to your question, so I mentioned ETFs track the market, right? That's what, or should I say, passive investments track the market. sorry, I sometimes use ETF and passive investment interchangeably,
Uh-huh,
and
uh-huh.
I always get into trouble for it. But yeah, so passive investment is it just tracks the market. So you choose an index like the JSE Top 40, and you say this ETF or passive investment is just going to give me what the top 40 does, nothing more, nothing less, right? And that's the point of passive, is you're not trying to outperform. Because every time you try to outperform, it means that there's a chance that you could underperform. And even products that outperform, over the long term, they will go through periods where they underperform, right? Um, so what the smart beta does, it says, okay, let's take the top 40 for example. So it says, okay, we see this top 40 index. It's all good and everything, but we think we can do a bit better because we believe if we buy only companies that are what we think are undervalued, then theoretically over time, even though we're doing it passively by not by sticking to a set formula and not having someone's with an opinion saying, oh, we think this is going to do well because of this and this and this. We just use some measures and ratios, and we define that, and we define undervalued companies by that, and we'll put them in according to that. So now we have sort of a top 40 index, but we're trying to be a bit more clever about it in the hope that we'll outperform. Am I making sense?
Yes, yeah, you are.
Okay.
It's a lot to take in, but you are.
um, okay, so you've got this product now that's aiming to outperform the index. And what they'll do is they'll run this model that they have, and they'll go back to 1970 and they'll run it forward based on all this historical data. And wow, would you look at that? It actually did outperform the market. So this must be a good product,
Right.
and it probably is. But going forward, there's no guarantee that it's going to continue outperforming the market. And in America, so sorry, that's what these smart beta products are.
Yeah.
They are passive investments that try to do a little bit better than the regular vanilla index by trying to be a bit more clever about it. And these smart betas have sort of been in America for many years already, and they're just starting to take off now in South Africa. But Jack Bogle, who's the founder of passive investing, he founded the Vanguard company, which is the basically the pioneers of ETFs and passive investing. And his view on smart beta is that they actually don't end up outperforming, because what worked in theory doesn't always work in practice. And as more and more people rush to invest in products that might exploit any inefficiencies in the market, those inefficiencies go away because there's so much money coming in to close that gap. So basically, over time, the chances of you actually outperforming the market may not be as high as what the product providers initially thought. But maybe the bigger issue with them is that you're buying this product in the hope that you outperform. Now, what happens if you go through an extended period where this product's not outperforming and it's underperforming? Now you're going to be thinking, maybe this wasn't such a good idea. Maybe I should do switch to another smart beta product. And what do you think is going to happen as soon as you switch out of that product? It's going to start outperforming again. And now you're going to be like, should never have moved. And then you go and move back again. And so your whole investment strategy starts becoming almost active, and you end up shooting yourself in the foot.
Yeah.
Whereas if you just stick with a vanilla ETF, you're getting exactly the market return, and nothing more and nothing less, which is kind of in my view what every investor should be aiming for.
Yeah.
So look, I've got nothing against maybe having a small portion of your portfolio in smart beta. For some people that small portion might be cryptocurrencies. For others, it might be individual stocks. For others, it might be small caps. For others, it might be what's this new blueberry farming and honey farming crowdsourced initiative. For others, it might be like peer-to-peer lending. I've got no issue with maybe saying 5 with a stretch, maybe 10% of your portfolio into something a bit more exotic and exciting. Because let's be honest, ETF vanilla investing is pretty boring.
Yeah.
Nothing much happens. But yeah, if you're going to be doing more than 10% into smart beta, I'd start becoming a little bit concerned.
Yeah, but I think you say vanilla investing is boring, but I think people miss out on that advice, because if you were told, hey man, just basically get an S&P 500 or get some sort of MSCI World thing, and that's kind of the only investment that you're going to have to make if you want to comfortably grow your money over time, they would say like, wait, what, is that it? Is that all it is? But is that what you're saying to people? Are you saying it's as simple as buying, for example, an MSCI World or an S&P 500 and letting that grow over time? In your TFSA experience, is it better to just do one ETF and that's it? It's finished. It's over.
Yeah, if you got a broad enough broad enough index, one's enough. If you're going to do a Satrix worldwide,
Yeah.
or a Ashburton Global 1200 is the other really broad-based worldwide one, you're going to be just fine.
Mm.
Um, Investing doesn't take a lot of skill. If you're going to buy just that one product, you're going to do fine. What you need a lot of is time and patience. That's where people suffer. The buying the product's easy. It's the waiting for the returns that people get impatient. And again, it comes back to the dieting thing. People don't want to eat well and exercise. They want a tablet that they can take and make them lose weight now. But doing it the right way takes patience, and it's going to give you the greatest chance of success.
Right, yeah. No, I like it, man. I like that because nobody tells you that. Even in school, nobody tells you that, I come from a
Yeah,
class
and
of
the
individuals.
industry,
Go ahead, go ahead, go ahead.
the industry wants you to believe that it's complicated because, unfortunately, they're not going to be able to charge you much fees for simple, right?
Yeah.
They're relying on your thinking that, oh, China's economy is slowing down. That means we need to move our dollars into pounds because but then there's Brexit. So no, now we need to move into the DAX 500 in Germany. They want you to think that because they can charge fees for doing all of that, and they want you to buy and sell because they're making brokerage every time. But
Oh.
all you really need to do is just stick your money into a broad-based index tracker, and you know what, you're going to do just fine as long as you're willing to ride out the bumps. When the rand tanks to 1550 or whatever it was, just
Yeah.
sit tight.
Yeah.
Sit tight.
So it's like everything else is basically fake news. It's all just fake news. That's what it is. I can't believe
Yes,
it's.
but can you imagine? Can you imagine opening Fin24 and the leading story is invest in ETFs for the greatest chance of success, and then you go next week and you open it and it says ETF investing is the way to go. Then
Yeah.
they're never going to sell any advertising with that. They want you to read rand
Yeah.
tanks to
Yeah.
1550, move your money to US dollars now. And there was a headline along those lines, I think a month ago,
Yeah.
and pretty much a week after that, the rand was back at 1450 or whatever it is.
Yeah.
So they want you to act and live in the moment, but all you really need to do is just have a bit of patience and just ride out those bumps.
Yeah, it's truly unbelievable. Hey, I mean, what happens in the 24-hour news cycle? But Stealthy, I think what most people lack in South Africa is a document of sorts to go to and to get the basics. And do you have a document on your website that gives somebody the kind of 101 when it comes to the way that you are investing your money? Do you have an ebook out? Is that true?
So it's going to be a 20% upfront fee and a 3% annual fee to see that. No, I'm joking. I don't have a sort of 101 document, unfortunately. It's maybe something I should look at putting together. But I mean, if you're not sure of anything, whack it into Google. In this day and age, there's good info out there. I can appreciate that sometimes it's just like a flood of stuff, and you don't know what to believe and what not to believe. But I mean, there's in South Africa, there's quite a few people. If you just drop them a mail, they'll be more than willing to send you info you might need. We were discussing before the show, Just One Lap. It's a fantastic resource. I've never once had an email go unanswered. They maybe take a day or two because I think they're getting quite busy now. A lot of people are jumping onto this do-it-yourself investing bandwagon, so I think they do deal with a lot of mails. But every time they get back to you, and the answers are normally on point and really helpful. I've also been fielding quite a few emails. I'm more than willing to help where I can. Obviously, I'm not a financial advisor, but I'll happily give you my 2 cents, and you can take it or leave it, and I won't be offended. But yeah, there's a ton of resources out there. I see there's also 1 or 2 other blogs that's been up and coming recently. Wealthycontent.co.za is the one, and hamsterwheel.co.za is the other one. I'm sure if you drop those guys a mail, they'll be more than willing to help. This DIY investing is really a community. And ask the questions to the people. In general, the feeling is that everyone wants everyone to be better off and wealthier. I mean,
Yeah.
that will be great for the country and great for us individually.
Yeah, I think with what I'm trying to do as well. I'm not very invested in financial content, but when I see that there has been a lack of education for a lot of the people in the country, I want to almost Albert Einstein it down and tell people, listen, we need to explain this like we're explaining it to 5-year-olds because that's the only way we're going to get it down. So I want to really, really simplify it, and maybe a chat like this is not simplified it at all for somebody, but maybe 1 or 2 lines out of it has been simple enough enough for somebody to think, oh, what's an ETF? What's a TFSA? And there they start learning. And I think there's been a huge boom in South Africa when it comes to podcasting and that kind of stuff. So people are really taking their interests and now taking them off of the platform of radio, for example, and saying, okay, I have to figure my finances out. So I'm going to have to find a podcast. I'm going to have to find a book. I'm going to have to find something that simplifies this for me. And it's Stealthy. I think you've done a really, really good job in terms of simplifying it for people. And you continue to do so. But that's the thing. Whilst you've been running for the last 2 years, Stealthy Wealth, I mean, have you seen people kind of gather around and go like, listen, man, you're really helping me out here. Have you seen a community grow around it?
Yeah, absolutely. I even one of the readers suggested like a meetup. So there was one. There's been I think two or three in Joburg now, and there's been one in Cape Town. And next year I'm planning to sort of, arrange these things in multiple cities across South Africa. So there is definitely I get the sense that a community is growing. And what's really encouraging for me is I would say about a third to a half of the emails that I get from the blogs readers are actually students or people that's just entering the workforce. And for me, that's a really positive sign that the young people are actually starting to say, hey, I need to take control of my finances. I'm the one that's going to be responsible for all of this. If I'm eating baked beans in retirement, my financial advisor is not going to lend me his tin opener. At the end of the day, you're responsible. And I think that the young people are starting to get it. And I think that's fantastic.
Yeah, listen, Stealthy, we are going to keep you on speed dial, and for anything that millennials might want to figure out in terms of investment and finance and personal finance, we're going to phone you. But go and check his website out. It is stealthywealth.co.za. And you might learn a thing or two from the blog posts that he has posted. One of the more recent ones is how one email saved me 83,000 Rand. So I think next time we talk to Stealthy, we're going to figure out what that is. But Stealthy, thank you for joining us here on the Quintessential Show today.
No, my pleasure. It's been really great chatting to you, man.
All right, cool. Till next time, buddy.
Cheers, man.
Cheers.